What's actually in the Genius Act? The bill refers to stablecoins as a digital asset meant for payments or settlement, and the issuer has an obligation, a legal duty to back it with an equivalent amount of real money. So who can issue these? We're talking regulated players, specifically subsidiaries of insured banks, depository institutions. And this is important. Specially approved non-bank companies that meet some pretty strict requirements. So they're tightening the reins on who can create these things. So say you are one of these permitted issuers. What does the Genius Act actually demand? What are the core rules for issuing? The absolute headline requirement is strict one-to-one backing, meaning issuers must hold reserves equal in value to all the stablecoins they've issued. No fractional reserve stuff here. And what kind of reserves are we talking about? Can they just hold anything? Nope. Very specific. Think ultra-safe liquid assets. We're talking actual US coins and currency, deposits at insured banks, short-term treasury bills with 93 days or less to maturity, certain repurchase agreements, or even money market funds. But only if those funds themselves invest solely in these permitted assets. And maybe the most critical rule here is that these reserves can't be used as collateral for something else, or reused in any other way. The reserves have one job: back the stablecoins. It's designed to build absolute confidence that the backing is really there. What about transparency? How do we know they're following these rules? Issuers have to publicly disclose their redemption policy, how you get your money back. And they need to publish monthly reports detailing exactly what's in their reserves. Not only do those reports have to be examined by a registered public accounting firm, the CEO and the CFO have to personally certify these reports. And there are criminal penalties if they lie. These issuers are treated as financial institutions under the Bank Secrecy Act. So AML, KYC, all that applies. Anti-money laundering, counter-terrorist financing rules, etc. It brings them fully into that established regulatory fold. How is this all enforced? Who's the referee? You've got federal regulators, like the OCC or the Federal Reserve, overseeing different types of issuers depending on their charter. But the bill also allows for states to create their own rules, as long as their rules are substantially similar to the federal framework. So it allows some state control, but maintains a high baseline standard. It's an interesting balance, but there's a key threshold. If a state-qualified issuer surpasses a $10 billion market cap, they either have to get a federal license, basically come under federal regulation, or they have to stop issuing new stablecoins. Regulators will have broad powers related to supervision, enforcement, suspension, issuance, fines, the whole toolkit. What about the person actually holding the stablecoins? Are there protections for us? Yes, absolutely. Customer protection is a big focus, and firms providing custody services must segregate customer assets. This means treating them legally as belonging to the customer, not the firm. No commingling those funds with the firm's own operational money. Imagine a separate digital vault for each customer. It protects your assets if the custodian runs into trouble. If an issuer goes insolvent, becomes bankrupt, the stablecoin holders get paid back first. They have first priority over other claims against the issuer. That's huge. For years, there's been this constant debate. Are stablecoin securities? Are they commodities? What does the Genius Act say? It actually goes in and amends several major financial laws. The Investment Advisors Act, the Securities Act of 1933. It states pretty explicitly that payment stablecoins, if issued by one of these permitted issuers under the Act, are not considered securities or commodities. Instead, it creates a specific category for payment stablecoins. A clear legal status, finally, for those that comply with this act. It removes a massive cloud of regulatory uncertainty that's been hanging over the industry. That could open the floodgates for adoption by giving institutions, users, everyone much clearer rules of the road. This focus on structure and trust might even change how we all view digital currencies, and ultimately help streamline how we pay for things.